The two key words in this forecast, and I'll put them up here to keep them in front of everybody's eyes, were, first of all, collapse, and secondly, disintegration. Oh, plan ahead. Now, in this, with my inimitable calligraphy, I'm sure that you'll have no problem in keeping these two, collapse and disintegration, and what these might mean. What LaRouche pointed out was that during the course of 1994, 95, and perhaps into 1996, the world financial system would go through a series of collapse phases. And then, sometime during 1996, or perhaps in 1997, but in all likelihood, during the time of President Clinton's first term in office, we would go into this disintegration phase. And that this would then bring us to an unprecedented world financial crisis. In other words, it would be the worst economic and financial crisis in all of recorded human history, far exceeding any previous breakdown on the historical record. Now, probably the first thing that you wonder is, what's the difference? What's the issue here, right? Why is collapse and disintegration different? How do these diverge? Well, the notion of a collapse is primarily the idea that the values of stocks and bonds and real estate and things like futures and options and what have you, all of these go down. They decline massively. Probably the biggest epistemological problem that people have in the United States today is that the Dow Jones Industrial Average remains above 4,500 points. And this generally, for those who have been dabbling in those markets or in the associated futures or options, tends to blind them to any larger reality. But if the Dow today is at 4,500, right, it could go down to 500. It could go down to 100. It could go down to 20. And that would be a collapse. And I'm not predicting any of that, so don't run out to call your broker quite yet. But I think this is the general course that events will take. That's a collapse. A collapse is something like 1929. From 1929 to 1933, we had a collapse. It meant that the prices of stocks went way down. The prices of bonds went down too, although far less. There was a general banking crisis, which was associated with the insolvency of virtually every bank in the United States during the winter of 1932 to 1933. But in the middle of this, if you had a dollar, you were in pretty good shape, because a dollar would buy a lot. That happened to be a deflationary collapse back in those days. That got us to 1933. Millions of people were thrown out of work, right? The real unemployment rate got up to approximately 30 or 35%. So this gets to be very, very bad in terms of the social and political consequences. But still, the banking system, more or less, so that it had to be saved from bankruptcy, but this Federal Reserve System, the dollar, and so forth, all of these continued more or less on their way, although certain administrative measures had to be taken to save them. So you can compare this to even 1987, right? 1987 was a kind of a collapse, although, as it turned out, a relatively mild one. Now, beyond the collapse, though, there's disintegration. And as I'll try to show you in just a minute, the most interesting model for disintegration is what happened in the Weimar Republic of Germany in the years of 1921, 1922, and 1923, within the framework of the fabled hyperinflation of those years, a kind of superinflation that destroyed the value of all of the currency and all of the financial instruments in the country. Disintegration is something different. Disintegration goes beyond collapse. You have to remember things like Confederate money. Now, I know this is a touchy subject for some, but you have these pieces of Confederate money, and it's got the signature of Jefferson Davis or somebody on there, and it says, the Confederate States of America promise to pay, blah, blah. And of course, they're not going to pay. And if you have that, it's just paper. How about Tsarist Russian government bonds? You have those, right? It says, I, Nicholas II, Tsar of all the Russias, hereby promise to pay. Well, I'm afraid he's not going to pay. If people remember the cartoonist Al Capp, he's largely forgotten now, but there used to be this comic strip called Little Abner. And during the Cold War, Little Abner used to talk sometimes about the Raspuchnik. And the Raspuchnik was somehow a figure for the Soviet-Russian ruble. But the Raspuchnik was a currency instrument. And the peculiarity of the Raspuchnik was it had negative value. Now, how, you may ask, could a currency have negative value? Well, the answer came, you have to get some carding company, pay them to take it away. Now, what I'm trying to point to is the problem in disintegration, which is of this order. You may have, for example, dabbled in those Chicago markets. You may have options. You may have futures. You may have index options. These are very rarefied. You have to ask yourself what that kind of paper is ever going to be worth as we go through the collapse phases into this disintegration phase. And I'm afraid that you're going to find yourself holding a large number of Raspuchniks. Those Chicago markets, I'm referring to the Chicago Board of Trade paper side, the Chicago Board Options Exchange, and the Chicago Mercantile Exchange, to the extent that they're offering you futures and options on indices and futures on indices, you are at many, many removes from any tangible productive asset that could be put on the block in some kind of a bankruptcy auction. I have to remind you that most of those Chicago markets 25 or 30 years ago did not exist in that form. There were no futures options indices of the type that you have today. And I think it's very likely that before too many years go by, before this old planet goes through too many more seasons, you're going to find that those markets will once again cease to exist one way or another. Now you turn your attention to Lower Manhattan, and there you find that there used to be a tree near the wall that they had built at the lower part, right, to try to keep the Indians and other attackers at bay in the northern part of Manhattan. And that starting, I believe, in 1792, businessmen would meet under that tree for the purpose of exchanging various kinds of merchandise. And that is the legendary origin, if you will, the sort of the Romulus and Remus of the New York Stock Exchange. And that's been going on since 1792. Now, will that continue to go on into the 21st century? Well, your guess is as good as mine. And then we get into the area which is even more exotic, if you will, which is that of the derivative security. Now, people always ask, what's your definition of a derivative? What is a derivative? I can only answer, derivatives are, by and large, paper based on paper. Remember that if you have a share of stock, you're supposedly the part owner of a company. If you have a bond, you've got first call on the assets of that company if they go bankrupt. But if you have an option, what do you have? If you have a future, what do you have? If you have an index, you said, well, I've bought the Standard & Poor's 500 index. What is that? It's a series of pieces of paper. I have to warn everybody, a lot of people have been told that mutual funds are somehow a safe investment. Don't look now, but mutual funds are derivatives. You buy the T. Rowe Price or the Fidelity Magellan or one of these other pieces of hokum, what you have essentially bought into is a piece of paper based on other pieces of paper. And all of the derivatives that I've mentioned so far are all hopelessly old hat. Those are very conservative. We have to go beyond those into the areas of mortgage-backed securities. Again, it's a security that's based on mortgages, paper based on paper. They have other things called structured notes. Structured notes occur when one yuppie with a laptop gets online with another yuppie with a laptop, and they begin to structure a series of deals, right? It's you give and I give, and I'll give you the London interbank overnight lending rate, and you give me the going rate on the bonds quoted in the Tokyo Exchange, and on, and that sometimes goes through 250 permutations. They have a derivative called a reverse floater. Now, I'm not referring to something obscene out of some kind of a sex manual, but the reverse floater is a security where if the interest rates go down, the price of the security goes up. If the price of the security goes down, that means that the interest rates have gone up, and so forth. There's another one called the triple wedding band, which is a triple band cyberspace arrangement where the value floats in the middle of bands, and if it goes outside of the bands, then you lose money. And on and on and on. George Soros of the Quantum Fund, administering the funds of the Queen of England, he earned $600 to $700 million in one day in 1994, speculating on these things, and he then announced in this year that he lost $300 million on the dollar in one day. So you're into the realm of derivatives. Now, what I'm trying to point to is that with the growth of the derivatives, the disintegration comes closer. To sum it up, what we're trying to forecast is that not just these little markets like the Chicago market or the New York Stock Exchange or things like this will become insolvent, but at a much higher level. The Federal Reserve System is intrinsically bankrupt and insolvent. In particular, the New York branch of the Federal Reserve, which is by far the largest and indeed the flagship in policy terms, is bankrupt. The Bank of England is bankrupt. The Bank of France, the Bundesbank, and so on down the line. The Japanese Central Bank, they're all bankrupt. The International Monetary Fund is insolvent. The World Bank, the Bank for International Settlements, the OECD, and if I've forgotten any, you can fill in the blanks. They're all bankrupt. And as the disintegration goes forward, if we ever get to that point, which I sincerely hope we don't, you will see a bottomless thermodynamic devolution in which all of these things are swept away. And of course, they then mean, if all of this system goes, that the existing mechanisms of production, distribution, consumption, in short, human life in the real sense, will be threatened by the dimensions of this crisis. LaRouche said the other day he thought a lot of people were kidding themselves even if they bought options on gold. The options can never be exercised in many cases, and that people who were buying into commodities, beans and pork bellies and things like that, and taking delivery immediately were probably the smart money on these international markets. Now let's look for a second at this. Now we're going to come back to disintegration in just a minute. I'll try to show you some of these pictures from the Weimar Republic. Let's look at the dimensions of this problem. I'm going to show you in a minute some slides which suggest that the derivatives bubble in the world economy is somehow of the order of 40 to 50 trillion US dollars. I am afraid that things in this area move so fast that slides that were only made a couple of months ago are now totally obsolete. They no longer mirror the real situation. The real situation, according to the best estimate that LaRouche can make, and I think he's the eminent authority on it, is something like this. We have a worldwide financial bubble, and it is to be estimated in the area of $1 quadrillion. Now that's a colossal sum. Here's a million, a billion, a trillion, a quadrillion. That's the bubble. That is now the best estimate we can make of the sum total of derivatives, junk bonds, stocks, bonds, real estate, pension, benefit guarantee corporation, Federal Deposit Insurance Company, corporate debt, credit card debt, right? On and everything else. All kinds of paper that are now crushing humanity and this planet. Now, this is a big, big increase compared to LaRouche's last estimate of what this was. Approximately a year ago, LaRouche was estimating that we were in the range of 400 trillion. And we're now up to 1,000 trillion. So as far as I can see, that means that the rate of growth of the paper in the bubble is now something like 200 to 250% per year In other words, about 600 trillion of this bubble has been added in the last 12 months. Surely these are the last days of Pompeii. Now, I'll try to express this in 1,000 billion. So it's essentially 1,000 trillion in the bubble. Now we have to recur to LaRouche's economic analysis, which is always that economic processes present an apparent dualism. It's not a fundamental, it's not an ontological dualism, but it's an apparent one. Where on the one hand you have the paper circulation, the world of paper and paper profits and stock jobbing and junk bonds and derivatives and the yuppies and the laptops. But then there's also got to be the survival of human society, social reproduction, commodity production, tangible physical wealth, and making real things that you can eat, that you can use, the world of use values. As against the 1,000 trillion in the bubble, what can we estimate as real world economic production right now? Agriculture, industry, construction, scientific research, mining, trade, and so forth. It's approximately 10 trillion. And don't think of that as dollars so much. That's simply the dollar measurement of the production of real use values, food, cars, steel, housing, and so on down the line. So you can see that this is now, it's approximately 1%. Now remember that the 1,000 trillion in the bubble has got to be paid out of the proceeds from the 10 trillion in real production. It looks pretty bad, doesn't it? But now the monetarists will step in, right? We have the monetarists, and they'll say, wait a minute, it's not that bad at all. Because, of course, you don't have to pay the whole bubble every year. You don't have to pay literally every derivative every year. All you have to do is pay the rate of profit on the derivative bubble and related things. Well, okay, let's say we're going to be very conservative on this. We're going to say that no self-respecting yuppie with a laptop would accept anything less than a 10% rate of profit. Okay? So 10% means 100 trillion. That's your yearly debt service bill. In other words, that's the cash flow that you've got to have in terms of profit to satisfy the rollover requirements of this rather large sum up here. Now, of course, I'm afraid I have to apply down here what I also applied, what I did to the numerator, I must also do to the denominator, and that is that you don't get the whole 10 trillion of real production in the world to use to pay the bubble. You only get the rate of profit on that. Now, what's the rate of profit on real production? It's less, because this is not yuppies with laptops anymore. This is more like the world that real people live in. Let's assume it's 5%. Okay? You're lucky to get 5% these days. And that gets us down to what? 1/2 trillion. And there is your ultimate problem. Is it possible to pay a yearly debt service rollover of 100 trillion with a cash flow profits of half trillion? Not easy. But don't despair. At this point, there's a yuppie with a laptop who comes in and says, look, this isn't as bad as it seems. Why don't we roll you over? We'll finance this. You simply need to borrow 99.5 trillion this year in order to be able to solve your problems in the new year. So with that, more debt service is added up here. And of course, the proviso that the yuppie with the laptop brings is he says, you've just got to do some downsizing. You've got to go through your operation and remove some of those wasteful, low-profit departments. You've got to fire 10 to 20% of your workforce and so forth. Which means then, in effect, that the 10 trillion is shrinking at the same time that we have this tremendous cancerous growth in the 1 quadrillion in the bubble. Now, this is a situation from which there is no exit. Harley mentioned before, we have the complete Pollyannas or criminals who say there's no crisis. All right. Then we have the ones who say, yes, a crisis, but it can be mastered with purely technical terms. And then we have the LaRouche camp, so to speak, which says there's a crisis, it's systemic, and it requires, the only conceivable measure here is a Chapter 11 bankruptcy. We must freeze and remove from consideration the $1 quadrillion in the world financial bubble, because it is crushing and phagocytating, it is consuming the areas of real production. Now, the way in which this has all, in the course of this, right, in other words, this is a kind of an aggregate of events that you've heard about, you're familiar with, right? For example, the Orange County bankruptcy in California. These are all things that have come after LaRouche issued this June 1994 forecast. In the case of Orange County, there was a man called Mr. Citron who really is not atypical of most money managers in the world today. I think what he did is exactly typical of what many money managers do, and really from the point of view of the world of money managers, what he did was not that daring, not that risky. It was indeed relatively less leveraged than the things that Soros does every day and continues to do. He had about what, $2 or $3 billion. He went to Merrill Lynch and they said, you give us that money and we'll lend you $7 or $8 billion more, and you can go out and buy all sorts of nice derivatives. And the result was that a little bit after Thanksgiving of last year, Orange County was bankrupt, and it's the biggest municipal bankruptcy in the history of the United States. Barely 3 weeks after that, around the 20th of December, we had the beginning of the Mexico crisis, which was a crisis of the Mexican peso, a crisis of the Mexican stock market. More profoundly, it was the crisis of every so-called emerging market across the world, from Poland to Hungary to India, to every one of them. Every third world country that had been protectionist in the past, which is now opened up to free trade, was in the same position as Mexico. And indeed, many countries scrambled to issue press releases, Argentina, Brazil, and others, saying, we're not Mexico, please don't lump us in with all of that problem. Now, we had the forces of the conservative revolution in the U.S. Congress who were fiddling while Rome burned. This was Gingrich and Graham and many others who said, we don't want to bail out those third world socialists and other people down there, those corrupt people in Mexico. So therefore, we're going to stall on any kind of a bailout package. Now, what Clinton then did was to come forward with a bailout package that used, quite frankly, the instruments of the old system. It used the IMF, it used the Bank for International Settlements, and others. At the time that he did this, we were at the end of January and the beginning of February of this year. And we were literally at about 48 to 72 hours from a massive meltdown of the entire world financial system. In other words, we were in the area of a very severe collapse. And it would have gone from the bankruptcy of the Mexican banking system to the bankruptcy of the Wall Street banks, and then a general worldwide panic would have ensued. And that might very well have been the transition from mere collapse into the area of disintegration, because it would have meant that a lot of the Wall Street banks would have been not just bankrupt, which they really are today, but somehow publicly, in flagrante, bankrupt. So Clinton then stepped in with his $50 billion package. Now, admittedly, at the time, we said, that won't work. That's very nice that you've avoided a worldwide panic, and you do get a certain amount of credit for that. But it is not a solution. And I'm afraid that has turned out to be true. What is going on right now in Mexico is a very violent contraction in levels of production, employment, national income, import-export, and so on down the line. It is something similar already to what went on in the United States between 1931, 1932, 1933. That is now the reality in Mexico today. But the crisis rolled on in the form of a dollar crisis. When you look at the fact that the Dow is at 4,500, you have to remember that has to be relativized with the fact that the dollar has lost 15, 20, 25% of its worldwide value over the last several months. Depending on how many months back you want to go, you'll get up to figures of 25–30%. So if the dollar goes down by 30% and the stock market goes up by 10 or 15 or 20%, that really doesn't get you very far, does it, in terms of the international framework? The dollar is, of course, the reserve currency of the world. That goes back to the Bretton Woods Conference of 1944, and since 1971, we have been living in the ruins of the Bretton Woods system as it was laid out and wrecked by Kissinger and Nixon in that fateful August 15th of 1971. However, make no mistake, the dollar is in crisis as a worldwide reserve currency, but there is no conceivable replacement for the dollar. Neither the yen nor the mark is a serious candidate to undertake this function. So it simply means that the world economy is in big trouble with the only possible reserve currency in crisis and nobody coming anywhere near the requirements to take over. And then we have the British side of it, which is what then happened in the later part of the springtime. Barings Bank, this flagship branch of the City of London, the center of the Queen's property and all this other stuff, went bankrupt and was wiped off the face of the earth within just a couple of days. And of course, we had a new story that this time it wasn't Robert Citron who had done it, but it was Nick Leeson, that rogue trader in Singapore who had gambled so cynically with the widow's mites that had been deposited into his company. Of course, that's all nonsense too. Because not only Barings is bankrupt, but if you look at the celebrated company Lloyd's of London, we find that in recent years, based on their most recent annual reports, they have lost a total of $12 billion US. A heady sum, even in the world of quadrillions. And that Lloyd's is likely to be followed by the largest British merchant bank, S.G. Warburg and Company, with a kind of a business turnover of about $20 billion and assets of that type per year. So we are right now simply in one of the troughs of this crisis. And you notice one of the effects of these developments is that when you have an event like Orange County or Mexico or Barings, it sends out shockwaves. To the extent that the rest of the world stays relatively normal, in other words, it's a relative normalcy of these times of crisis, those shockwaves will tend to dissipate. But as you get these things happening in quicker and quicker succession, as you get a convergence of crises, as you get Orange County plus Mexico plus the dollar plus Barings plus Lloyd's plus Warburg's, then you get into the very dangerous geometry where these shockwaves begin to resonate. They begin to reinforce one another. And we then enter a realm of unpredictable singularity, which is otherwise governed by these Kolmogorov equations that govern the dynamics of thermonuclear explosions. When shock waves meet and begin to resonate and begin to amplify one another, we then get into something extremely dangerous. Before that background, we've had the Halifax summit. Now, the Halifax summit was interesting in the sense that some reality did creep in. Normally, ever since Rambouillet in 1975, we've had the yearly conference of the Group of Seven, and it's been some kind of a public relations extravaganza, often used for internal political purposes, but seldom did they come to grips with anything real. Now, this time, at least, the U.S. delegation said, look, we've had Mexico, and we've had Barings, and we should do something about this. Chirac, as Harley reminded at the beginning, talked about speculation as being the AIDS of the financial world. And I would also point to the fact that there was interest on the part of the three C's, Clinton, Chirac, and Chrétien of Canada, all agreed that unemployment was a serious problem and that there should be another unemployment summit that will be held in the coming year on the model of the one 2 years ago. And you know that the British don't like that. John Major and company don't like the idea of talking about real economics in the world of monetarism. Jobs really have no place on their screen. However, as a result of all of this, you could ask what possible progress had been made at Halifax. If you look at the final communique, virtually no progress at all. A little bit of reality had crept in, But in terms of solutions, there were none. And rather, what you had was the agitation of people like Jeffrey Sachs and others behind the scenes saying that what is needed is to put the International Monetary Fund in a position of the bankruptcy court of the nations. In other words, if your country becomes insolvent, you'll be hauled into the IMF, you'll be stripped of your sovereignty, and the IMF will dictate to you who you should pay, who you should not pay, whether you should, for example, pay your own citizens first, whether you should pay foreign banks and debtors first, and so on down the line. LaRouche has been very incisive about this, saying that the answer to our current crisis is not that the IMF should put the United States into bankruptcy, for example, or any other country, but rather that the United States should put the IMF into bankruptcy proceedings, and the sooner the better. Now, the other problem, which I think is relevant to this entire thing, is on the internal U.S. front, which was that a couple of days before going to Halifax, Clinton talked about the question of a balanced budget. Now, as we'll see a little bit later, we have a noisy group of demagogues in the Congress. These are the so-called forces of the conservative revolution. They are closely allied to the traditions of European fascism, which they tend to express in their own way. And they've talked about the need to balance the budget. Thank God they failed by one vote to pass their balanced budget amendment in the U.S. Senate, because that balanced budget amendment would have been a death warrant for the United States. It would have meant a guaranteed national bankruptcy, very, very short term, in the worst possible disorderly conditions. And it also would have meant that any military emergency or other emergency would leave us completely unprepared. As Senator Nunn, I think, put it, if you have a balanced budget amendment and you get a new world conflict. So the United States in World War II, if we had had a balanced budget amendment, we would have lost the war, guaranteed. No two ways about it. However, the Republicans say they can do this in 7 years, and Mr. Clinton, I'm afraid, says that he can do it in 10 years. We would not be in this situation if the reality of economic depression had been kept in front of the eyes of the U.S. population. I think the capital mistake, the central mistake that Clinton and his friends made during the 1994 election was the absurd claim that we are now experiencing economic recovery. There is no economic recovery in the United States. We are in an ever-deepening depression, which is taking the form that I've tried to show. So nothing could be farther from the truth than any claim that an economic recovery is going on. Clinton would have been better advised to point to the fact that he had inherited from George Bush an unmitigated disaster, which he was still attempting to bring under control. That would have been honest, that would have been the truth, and that would have appealed, I think, to many voters. As it was, given the fact that Clinton had declared the economic issue essentially non-existent, the Republicans were able to concentrate their demagogy in these ridiculous ideological obsessions of term limits, the balanced budget amendment, tort reform, and other, again, purely demagogic areas of agitation that get you nowhere. If you want to balance the budget, it cannot be done by the methods of budget cutting. And that is a very simple reality. We have to go back to Senator Graham at the time that he was Congressman Graham back in the early 1980s. He put his name on two pieces of legislation which have brought us to the present condition. One is Graham-Latta. Right? Graham-Latta was the Reagan administration's first budget and tax package that went through the Congress. Congressman Graham at that time was one of the leaders of the boll-weevil Southern conservative Democrats who were voting for Reagan. And then we also have to remember the infamous Graham-Rudman law of 1985, just 10 years ago. Now, according to Senator Graham today, the way you manage a national economy is the way you manage your family finances, around the kitchen table. And it simply means that you have to balance the budget. Well, this is not true. You see, the problem is when you're the United States government, you have a rather different ability to influence the economic conditions around you than an individual family might. If we look at the dimensions of the problem, the U.S. federal budget right now is about $1.5 trillion total. It's about $750 billion in entitlements and about 750 or 800 billion in discretionary and other kinds of spending. We have a gross national product in the area of 6 to 7 trillion. Now, I hesitate to say gross national product. This measure is a fraud. It includes a whole lot of nonsense. But even so, you can see the relatively large role of federal spending in the overall economy. It's about 1/4 of everything. And indeed, I think most experts would agree, if you get a paycheck, the chances are that it's about 1 in 4 that the ultimate source of that money is the federal government, that you're either getting Social Security, you're getting some kind of government job, there are several million people in that category, or you're working for a subcontractor that is somehow getting money out of the federal government or sometimes the state governments. The problem, therefore, is that if you try to cut this figure, which is what the conservative revolution boys want to do in the Congress, the Gingrich-Graham army cabal, well, you can do that, but if you do, you're lowering the general level of economic activity in the economy to a very, very large degree. You're cutting into payroll taxes, you're cutting into income taxes, you're cutting into sales taxes, and so on and so forth. So ultimately, you're lowering and decreasing and shrinking your tax base so that the more you cut this, the less tax revenue you'll have in the successive cycle. And ultimately, what has been shown since Graham-Latta and especially since Graham-Rudman over the last 10 years is go ahead and cut it. The more you cut it, the bigger the deficit will become, ultimately. Maybe not in the following year, but in the years after that. The only way in which the U.S. Economy, in terms of government spending, could be restored to a break-even level is through the creation of 6 to 8 million new productive jobs at the level of existing modern technology. That can be done in infrastructure, and it can be done in the industrial areas that are important for the creation of infrastructure, for steel, for concrete, for engineering, and so forth. And that happens to be the program that LaRouche brought forward in his presidential campaign of 1992. He said that we've got to direct dirigistic credit out of the U.S. Treasury into the building of infrastructure, and we've got to create 6 to 8 million new jobs within a 1.5 to 2 year period. If you create the 6 to 8 million new productive jobs, you're restoring a tax base so that the federal income would increase. And not just federal. You'd actually be creating the preconditions to balance the budget at city, municipal, county, state, and federal levels. And that's the only way to do it. So I'm afraid that the entire discussion about the balanced budget has completely missed the point. It's not a question of 10 years, 7 years, or whatever. You could do it within 1.5 to 2 years, as long as you're willing to dragoon that credit out of the Treasury into the hands of state governments and other prime contractors, and thence to other kinds of subsidiary contractors, and create the 8 million new jobs. If you don't do that, unless you see 8 million new productive jobs created, you can forget any notion of balancing the budget. And here again, the bankruptcy, intellectually and otherwise, of Senator Graham is clear. Now let's turn now to the views of the Weimar Republic. Now I'll just put a caveat on this, first of all. What I'm going to be showing you, we're going to start in a second, it is that what I'm showing you now are images of hyperinflation. It just so happens that the most relevant example of disintegration is a hyperinflationary one. Remember, Germany in the 1920s was a large, modern industrial country. And of course, it had been through World War I. It was subjected to the Versailles Treaty, subjected to reparations, subjected to British financial and related warfare. But it did undergo a hyperinflationary disintegration. Now, I would not predict today that the coming disintegration will take a hyperinflationary form. I can't predict this. The disintegration will come. It could be hyper-deflationary. It could be that with $1 you could live for 25 years like a nabob, right? Or it can be hyperinflation, where with $1 octillion you can't buy a piece of chewing gum. That's also possible. I don't know how it's going to come. All I can suggest is it's going to be disintegration, and it's going to lead to hyper-insolvency. Right? Everybody bankrupt, everybody liquidated, unless you change the policy before it's too late. So with that caveat, let's just we can maybe adjust the lights. This is sort of what we've had up until recently. You see the derivatives are over here. The derivatives are measured here. And here's the course of derivatives. So that by the end of last year, we were in the $40 trillion range on the derivatives. But again, this is hopelessly outdated. We're probably closer to 100 trillion or even more. It's very, very hard to say this, because the difficulty that we face is that the largest area of growth seems to be in the over-the-counter derivatives, the so-called designer derivatives, the ones that don't go through the Chicago exchanges but are simply the yuppies with their laptops making these interminable contracts among themselves. So you can see, however, the area of exponential growth of the derivatives. If we wanted to show this into 1995, we'd probably have to change the scale, because it's going up too fast. Now, that puts us into the right frame of mind to look at what hyperinflation looked like. And again, it's only one model of disintegration, but it's the good historical model that also gives us insights into the politics of our own time. Now, here's a German banknote for 1 million marks. An interesting thing to start with, right? I mean, there is no $1 million bill. I don't know how far it goes up, right? Somebody who's seen one of these things more recently might refresh my memory. Do we get up to 10,000, I think, is the most in the U.S., right? But if you have one, you can just put it in my hat at the exit. So here's $1 million, here's a 1 million mark bill. Now, before the First World War, the German mark was about 4.2 to the dollar. It was the days when $5 made a pound, and 4.2 German marks made a dollar. And the largest banknote, I think, that they had before the First World War was something like a 1,000-mark note. Now, the hyperinflation began. It began in some ways during the war, but it really began after the war. And as I say, it's a result of the fact that the Allies, under their Versailles Treaty, decided to impose a bill of about $35 billion US plus interest on the German economy. This was, of course, a colossal, absurd sum, the equivalent of reducing everybody to slavery. And the British were practicing total financial warfare against Germany in order to definitively destabilize the country. And of course, they wanted to break it up. They wanted to divide it into various regionalisms. There was also a problem of British agents inside the German government, right? These are always inside-outside operations. One of the leading German agents was this character, Rudolf Hilferding. You may know him. He's somebody that Marxists polemicized with. He was a social democratic finance expert, and he wrote a book about finance capital, and he's one of the people who got the presses going. So here we are with 1 million marks of a Bavarian bank, and here's a baker who's getting his wages. And these are the wages. What you can't see here so well is that his wallet is already obsolete. He's got a cigar box to take the money home in. Now, in terms of getting paid, German workers used to get paid once a month. Because of the hyperinflation, if you got paid once a month, your money wasn't worth anything. You had to get paid once a week, then once a day, then twice a day. And the spectacle was the wives of the workers would go to the factories and get the money at least once a day. The mark depreciated every day at noon because that was the dollar mark fixing in the main Berlin financial market. So if you had money in the morning, you had to go out and spend it. Because the one thing you knew was that if you kept the money into the afternoon, it would be worth a small fraction of what it had been worth in the morning. It was double-digit inflation per day. And you had to buy anything you could get. You couldn't wait to buy what you wanted. You had to buy anything. Any tangible physical object was what you needed. Because once you had that, you could trade it. But if you kept the money, you would inevitably lose. So the wives would come, troop over to the factories, get the money, and then run to go and buy something as soon as they possibly could. Now things are getting worse. Here's a 5 million mark note. And here's a grocer. He's got a cash register. This too is obsolete. Notice, National Cash Register. He's now got, again, you can't see it so well here in these old photos, but what he's got there is a large packing crate. And it's full of 5 million mark notes. As a result of this hyperinflation, if you had a fixed income, you were destroyed. If you were a bondholder, you were destroyed. If you were anybody working for the government, if you were a teacher, a professor, a government official, a military officer, you were ruined because your pay never kept up with the rate of the inflation. Lawyers, you'll be glad to know, lost big. Lawyers were ruined because these sums of money, they say, I'm going to sue you for 25 million marks. Well, unfortunately, by the time the case ever got to court, 25 million marks was not even your car fare to go down to the judiciary buildings. The people who did well were speculators, criminals, prostitutes, male and female. They profited from this, and you have to draw very obvious parallels between the social dynamic of the Weimar Republic and Russia today. Because in Russia today, you have the ruble between 4,000 and 5,000 to the dollar. You're already getting into the area of hyperinflation as it was known in the Weimar Republic. Okay, now these are some of the things. These are the wives going to a butter store, a dairy market, to try to turn that worthless money into tangible physical commodities before the stroke of noon. Here's another typical feature. These are big baskets that they use to go and get the payroll. It's a middle-sized company, and they've got to use these huge wicker picnic baskets to go and get all of the banknotes for the bi-weekly payment. Now we're up to 500 billion marks. Look up there, you can see all the zeros. 500 billion. And now you're getting to the area where paper money is simply not acceptable. We're getting into the Raspuchnik area. Here's a movie theater, and they're saying this afternoon we're putting on the movie Judas. An interesting, probably something about Dr. Schacht. And the entrance fee is 2 bricks of coal. You see these pieces of coal they have? That's to get your ticket because they don't want money. Right? Maybe this is the 12 o'clock show, and there's no way to get the money to buy something with before it's completely devalued. So barter economy was the order of the day. Even in the world of stamps, this is interesting. You have your 2-mark stamp, your 20-mark stamp, then you're up to 4,000 marks, 1,000 marks, and then you're soon up to 10 billion marks for a letter. Right? Many people would find that they'd get their pension check or their contract money reimbursement, and the stamp on the envelope was worth more than the check that they got on the inside. Many of these things went out of business. One of the big crises was among restaurants. You'd go to a restaurant for lunch, and you'd order the food, and you'd say, oh, let's have some, Jaeger Schnitzel for, 5 million marks. Then the bill would come, and the Jaeger Schnitzel was 15 million marks. What had happened? Well, the mark had depreciated during the time that you were sitting in the restaurant. And this sounds a little bit absurd, but this is literally what happened during the course of the inflation. It was so rapid that you could hardly go into a restaurant and buy anything because by the time you had to pay for it, the currency had been completely devalued. Now we get into areas, some areas, this is funny, the Notgeld doesn't mean it's not money, it means Notgeld, it means emergency money. All right? They would paint over, here's 1 billion marks pasted over an old 100-mark note, and here's a new 10 billion mark note. We can just push on. I think we have a couple of more images of this type. And here's, of course, where it ends. Here's a 1,000 billion mark note. Now, this says eine Billion, but in English it really means a trillion. A trillion marks as a banknote. And as you can see here, we're in November of 1923. And, of course, the shredder. Now, if Oliver North and Fawn Hall had been around in the Weimar Republic, they would have found a very good area. They could have opened up a big shredding company. And this, you see, these poor little kids are pressed into action to tamp down the shredder. And what they eventually reached was an area, look, officially, the mark had gone from 4.2 to $1 in 1914 to 4.2 trillion. It's colossal. It's 4.2 thousand billion marks to $1, and that's the official price. The person who wrote the definitive work on this is an Italian economist by the name of Bresciani Turoni, who worked in the Versailles reparations apparatus, and he points out that the official price was 4.2 trillion, but you couldn't get that on the street. If you wanted to buy $1 on the street, you were up to 11 to 12 trillion marks to buy $1. If you could find anybody who would be so crazy as to sell it to you. So at this point, the process was brought to a halt primarily through outside intervention, through essentially the U.S. stepping in with some very dubious characters like General Dawes, right, the Dawes Plan. General Dawes, who became the vice president then under Coolidge and went on to do a lot of things. He was not a good guy at all. But the U.S. Did come in with these loans. They tried to get a certain amount of debt relief for Germany, a debt reorganization. They came in with these loans. Of course, this really, again, didn't solve anything, as the following years showed. But it did bring a halt to the hyperinflation. The problem you have today is, if you have a worldwide hyperinflation, including a dollar hyperinflation, where could that be halted? LaRouche always says, are there flying saucers that are going to come down with the new Dawes Plan to put an end to worldwide hyperinflation? I know this is dangerous to say, because I think a lot of people think that there are flying saucers up there who are going to do that, but we can't base our policy on that, can we? So the problem is today, once a worldwide hyperinflation gets going, how are you going to bring it to an end from the inside of it, with no longer any stable base of production and finance outside of the hyperinflation that could come in? I think we have one or two more here. Yes, this is the post-hyperinflation. This is a room that has been wallpapered with large denomination banknotes. Right? It got to be the point where it was waste paper, or else you could use it for wallpaper and get some value for your money that way. The ultimate reality, of course, is shown here. A mother and child essentially drowning and starving in a snowstorm of worthless paper. The real wages of German working people declined by 1/2 on an average during the course of this, and the middle class was completely wiped out. If you're interested in reading, if people want some references, I can give them to you later. If you want to see through the realm of novels what it was like to live in this situation, it was, of course, horrible. And I would try to point out one in particular, a guy called Stefan Zweig. He's a pretty well-known European writer. He called this the witches' Sabbath of hyperinflation. And he said that the middle class, again, anybody who was a bondholder, anybody with an insurance policy, anybody who was a government official, anything like this, professors, intellectuals, they were wiped out. And nothing made Germany ready for Hitler in the way that the hyperinflation did. It is the indispensable precondition to set the stage for an Austrian adventurer to become the dictator of Germany. And I think any competent authority would look at that and say, you do that to a middle class, you're going to get a fascist backlash. And the problem, therefore, is if you look at Russia today, virtually the same thing is now fairly well begun, and it might, of course, have the same result unless urgent measures are taken to turn that around. I think we have one more. Yeah, this is the Hitler people now. They come forward, as you see, the beer hall putsch of November 1923. The height of the hyperinflation was between the 15th and the 20th of November of 1923. And Hitler's first main attempt to seize power with General Ludendorff, military leader, was within about 10 days of the highest point of the hyperinflation. So hyperinflation drives an entire society mad and makes them ready to accept even the most insane and suicidal alternatives. I think that's the extent of what we have. Now, let us, if you want to